Perfect. Thank you very much. I was just told by the crew that they handle it like with festivals here, so they always keep the last person for the biggest act. So I'm going to be the last one between you and drinks, so please bear with me, but appreciate everyone that showed up. So today I'm going to talk about the paradox of DeFi and credit. Just very quickly about myself. My name is Jakob. My background is in startups, primarily like consumer marketplaces. For the one in Singapore, like foodpanda. I was one of the early guys for Asia, and fintech. So I've done a lot of alternative lending in Southeast Asia. And then about 2 years ago, I actually started a DeFi project called Clearpool. So Clearpool is a DeFi credit marketplace for institutions. So basically, institutions are being vetted. There's some risk assessment being done. They're signing contracts. And then they're opening borrower pools. And those borrower pools can then be funded by anyone in DeFi. We've launched approximately 1.5 years ago and have originated over $400 million in loans. So into the topic. So what is this paradox? So DeFi, the vision of DeFi is obviously to build a trustless financial system. You don't really need to care who's on the other side. You don't really need to care who you're interacting with. The only thing you need to trust in is the code. So the solution for DeFi lending were obviously the over-collateralized lending protocols, such as Compound, Aave, and Maker. You don't really need to care who you're lending to. As a borrower, you need to post collateral. You're getting a smaller loan in another cryptocurrency. If the collateral decreases in value, it's being liquidated. Lenders are getting back their money. That's a great solution. Now, what about credit? Credit actually comes from the Latin word credere, which means trust. So you trust. You give someone money and you trust that that person is going to pay you back in the future. Obviously, something very, very different. Credit is obviously interesting because it allows us to open up the market to a lot of different borrower profiles, but it also comes with a lot of difficulties. So that's credit and DeFi. Is credit and DeFi actually a good fit? So there are a couple of protocols that try to tackle this. Primarily, you can map them into two different types of protocols. There's the ones like Maple Finance, Clearpool, and TrueFi that focus on trading firms as counterparties, mainly high-frequency trading firms doing market risk neutral strategies across different exchanges. And because they don't have any directional exposure, they should, in theory, be pretty good counterparties. The other ones are guys like Centrifuge, Goldfinch, and Credix. So they have fintechs and credit funds as counterparties. And basically what's being happening is always some receivable financing. So you're basically lending against a deal that is secured by receivables, most likely invoices or something like that. Now, how did that play out? So you can see here, this is the lending volume of the DeFi credit players. Unfortunately, it looks a little bit similar to a lot of the crypto charts we see recently. Some people call it the Christmas tree. It really picked up. It reached $1.6 billion at its peak. That was approximately mid last year. And then I was a bit lazy with the chart, so the intervals are like on a quarterly level. But you could really see that 3AC and FTX incident. This is when it crashed down and became a lot smaller. There was also a little bit of a shift from the majority of the lending volume being with the crypto-native trading firms, such as Maple, TrueFi, and then also Clearpool. And it shifted a little bit more towards the real-world asset receivable financing ones, such as Goldfinch and Centrifuge. One of the reasons is obviously that people are not really keen anymore that much on crypto-related exposure. The other one is also that those loans are usually longer in tenor. So what happened? To be honest, a lot has happened, and a lot of not good things happened. There were defaults, and people lost money. Across all of the, or 5 out of 6 of the protocols that I just mentioned, there were defaults, and people lost money. And there were a lot of people saying, and I saw a lot of tweets where people said, credit and DeFi, that doesn't really work. Those two should not be done together. So what went wrong? What went wrong is the same thing that went wrong in CeFi. There were a company misrepresenting their financials. There was an assumption bias. We all thought that the Alameda guys are geniuses, and there's no way they can lose money because they're sort of owning the casino, right? And there was an African fintech that took the money and violated their covenants and spent it on something else. There was also a little bit of a tendency that basically what we just did is we took CeFi, we put it on chain, and then we applied the magic formula, which is liquidity mining, right? So this is one of my favorite memes in crypto, the humble DeFi farmer saying, it ain't much, but it's honest work, right? So for those of you who don't know, those are like farmers, yield farmers are people who supply liquidity into DeFi protocols, and then they earn a native token in those protocols, and then usually they sell them, and unsurprisingly, the token goes down. Now, when this started, all of the DeFi lending protocols were fueled by massive incentives. So you had like 40, 50%, and even 100% was not that unusual. Not with these protocols, but with other ones, right? Now, what happened is that a lot of people got into the market. They didn't really look what the base yield was. They didn't really look what the counterparty was. And then later, when all those tokens unfortunately went down, they were left with very, very low real yields. And they were complaining that they locked themselves up for several years, right? It also, sometimes protocols didn't really do a good job in pricing the risk properly because they had this, tokens they could just put on top in order to attract liquidity, right? But let's look at the facts. Actually, total lost or total defaults across those 6 protocols were roughly 60 million, which is obviously a lot of money. But if you put that, compared with the, in relation to the 1.6 billion, that's roughly 3.5%. Total defaults in CeFi, actually just the 4 main players, talking about nearly $22 billion. And 3 of them are the main CeFi players, right? So the other day, actually, I met a founder of one of the large CeFi lending players who is still around, and he introduced himself with, hello, I'm the founder of the only CeFi lending player that is still alive, right? So that is slightly exaggerated, but not really much. So how does DeFi actually improve credit? First one, obviously, very obvious, but very important, transparency. Now, when you put money into the Celsius, etc., it was like putting it into a black box. You didn't really know what was happening. They had problems. Nobody knew about it. Those problems grew larger, and at some point they were too large. And I think most of us, at some point last year, we probably received an email that said, "Dear customers, I'm sorry, but the withdrawals are being held," right? And then we're going to resolve it at our earliest convenience, and that earliest convenience probably like 10 years, if we're lucky. We can get anything back. Now, DeFi does not prevent defaults from happening. There's still going to be defaults. However, if anything happens, we can see exactly, who has what loan, what is the exact exposure, and that can prevent bigger holds from happening, right? So that's very important. I think here as well, as an industry, we need to do a better job. Just because it's DeFi doesn't always mean it's transparent. I've seen, DeFi protocols that only show what they want to be seen, right? But generally, if you have anything on chain, all the collateral, all the loan details, that is already a huge improvement. Second one, code is law. So, on our platform, if you don't repay within 5 days, it triggers a default. When FTX incident happened, some of those players reached out to us and asked, hey, can we repay a little bit later? Can we sort of like, discuss about it? And we said, like, no, there's nothing to discuss. This is a protocol. This is how the code works. You either repay or not. So now that is also very important because history has shown more and more, very often, the moment there is any sort of like, like restructuring, anything is happening, people trying to like extend, when a default should be called, that very often goes at the expense of the lenders. So if anything is wrong, a default should be triggered immediately and liquidation should be started immediately as well. So we see that works really well. Finally, these days, if anything, DeFi needs to be better than the traditional counterparties. Forget the CeFi lenders. I'm talking about peer-to-peer lending platforms in the normal world. So liquidity is one of those things where DeFi can be better, right? Like dynamic sort of like models where you have utilizations within pools, you can take out the money quicker, or maybe tokenization of debt tokens, right? Where you can create a secondary market. Now, that is still in the very early stage. Nobody really figured it out, but I think DeFi can actually solve this and improve it. And the last one is composability. This is something I'm very excited about. We've seen that, with our protocol Clearpool, there's several other DeFi protocols that built on top of it. One built a tranching product on top of our pools. There is like a yearn finance where you can get access to different real-world assets, yield sources, combine it with T-bills. There's a lot you can do, and more than just leverage. Finally, why do we need credit in DeFi? Well, the DeFi lending market, the over-collateralized one, works well, but it's a market of 13 billion. The total crypto lending market is roughly 100 billion right now. And then obviously, just to put out like a very big number, the non-bank commercial and consumer lending market is obviously a lot bigger. So if you want to really make DeFi more than just a small market between crypto natives, we got to tackle the credit market. Finally, I want to conclude with a quote. This is actually a quote that was not invented by Ronald Reagan, but it was used by Ronald Reagan in the Cold War. It is trust but verify. It's actually a Russian proverb. I can't really pronounce it. I tried pronouncing it with my Russian CTO this morning, and he had no idea what I was talking about. So I'm just going to keep it in English. But basically, during the nuclear disarmament, right, during the discussion with Gorbachev, Ronald Reagan constantly said, we need to trust each other, but at the same time, we need to verify that everyone is doing the right thing. And I think this can be a good slogan for DeFi and credit. And I think DeFi can actually help to make credit a lot more transparent and a lot more verifiable. So I think we still need to trust a little bit, but we need to do everything possible to make it the most verifiable there is. So thank you very much. I think this is the last speech. I wish you all a good rest of the day.